Hello, and welcome to another episode of SRT Live with me, your host, Sean Richard. Thanks so much for tuning in. And it's Tuesday, so that means it is the weekly real estate market update. So thank you so much for joining in. Glad that you're here. We've got a lot to cover today, but I'm going to try and keep it pretty quick. We've got a lot going on. Big news week this week economically. And we've had some good information come out of Ukraine as of this morning as well. So overall, we're seeing a lot of positive movement in the real estate and mortgage markets this morning. So let's kind of jump into the really cool data that we got today. So today we got two reports. We got one from Case-Shiller, which is a home price index report. So it measures home appreciation. We also got the FHFA, which is the Federal Housing Finance Agency. We got the FHFA home price index as well. And so the FHFA report measures single family residences with a conforming loan amount appreciation. And so you can have, this isn't measuring, those multi-million-dollar properties. Now, can you have $1 million property with a conforming loan amount? You can. And the conforming loan amount currently is anything under $647,200. So even those higher end properties, if they got a conforming loan amount, they show up in this report. And so Case-Shiller and the FHFA home price index talk about appreciation, measures appreciation in the single family residence market. So Case-Shiller came in at year over year price appreciation across the country at 19.2%, which is actually an increase from where it was the month before. Now, let me preface this by saying this is a 2-month lag on the reports. So the reports that came out today are for the month of January. And so January, 19.2 year over year appreciation. For December was 18.8. So we are still on the rise. We are maintaining those astronomical levels of home price appreciation. And the FHFA, again, also an appreciation metric, came in year over year, 18.2%. Month over month from December to January came in at 1.6% versus the 1.3% that we had for December, from November to December. So 1.6% from December to January and 18.2% year over year. These are just absolutely astronomical numbers, and we're getting them month over month over month. And you may say, well, how can we sustain this? And it comes down to the supply and demand. And I'm not gonna dive into that. I've talked about that to death. Check out one of my previous market updates. I talk about it in length. But ultimately, the supply and demand dynamic that we have in our current market, it's not going anywhere. The supply is not going to magically shift up, and the demand is staying really high, and that's causing home prices to continue to rise. So we got those two reports. Diving into some of the numbers from last week. Last Thursday, we got the unemployment claims, jobless claims, initial jobless claims. So this is individuals filing for unemployment for the first time, dipped pretty significantly. We've been hovering in the low 200,000 on a weekly basis. We dipped all the way to 187,000 jobs created for the prior week. And so these are post-pandemic lows. And so that just, again, speaks to the strength in the employment market, in the jobs market. We're seeing fewer people file for unemployment. We're seeing companies hold on to employees longer. And it's just strength in the employment market. And then continuing claims, which is renewals of unemployment benefits, it fell pretty significantly as well. The previous reading was 1.4 million, 1.41, and it dipped to 1.35 million. So we saw a pretty significant drop down in continuing claims. So again, strong labor market. Now, we also got pending home sales last week, and this measures signed contracts on single family, condo, and co-op properties. And the previous reading for the prior month was we were down 5.8%. The reading that came in on this report was we were down 4.7% on pending home sales. And the headline number is really easy to lead you in the wrong direction. And the media is they're having a field day with this type of information. Oh, the housing market's slowing down. Home sales are down 4.7%. The housing market's in a bubble. It's going to crash. And ultimately, pending home sales being down really just speaks to the inventory shortage we have. And I've said this time and time again, we can't sell what we don't have. And right now, we don't have inventory. And so pending home sales is going to decline because these are month over month numbers, and inventory continues to shrink. The most recent inventory reading for February is we had 870,000 homes for sale across the entire country. As recently as December, we had 910,000. So we're down from that. So we're shrinking on inventory, which is going to likely bring sales down as well. All right, looking ahead to this week, we've got a blockbuster week ahead of us. So tomorrow we get the ADP Payroll Report, and that's the precursor to the big Board of Labor and Statistics jobs report, BLS jobs report on Friday, which measures job growth for the prior month. So that's coming up this Friday. Tomorrow, as always on Thursdays, we get unemployment claims. So we get those jobless claims. We also get an inflationary reading tomorrow as well. We get PCE, which is personal consumption expenditure. Now, there's two critical inflationary reports. One is PCE, personal consumption expenditure. That's the Fed's favorite reading. That's the Fed's favorite metric of inflation. And then we also have CPI, which is Consumer Price Index, which measures inflation at the consumer level by measuring a basket of goods. And so PCE comes out this Thursday. That one is going to be full focus because inflation has been running rampant. We're at 40-year highs. And so watching what inflation does, are we at the peak of inflation? Is the Fed funds rate increase that the Fed did, is that going to start having impact? Now, full disclosure, it's probably not going to impact it just yet. A lot of times those rate hikes take a couple months for that to trickle into the economy. And so we want to keep an eye on that. I've said this before about inflation, but I want us to have this in mind when this PCE report comes out Thursday, is the last inflationary reading for last month didn't take in this consideration. It was, I guess, the reading from that came out in March for the month of February didn't have the Ukraine conflict baked into that number. The Ukraine conflict and all the energy pricing spike came at the beginning of March. So these April readings that we're going to get are going to be very educational on where inflation is, have we peaked? And as I've said numerous times, inflation is the enemy of interest rates. We're continuing to see interest rates rise. Inflation is a big culprit of that. So we need to pay attention. All right. So, and then I mentioned the Board of Labor says the jobs report on Friday. So what are we watching? What's important? What do we need to pay attention to going forward? And right now, one of the biggest items that we want to pay attention to is the yield curve spread, the yield spread. And I'm going to share this with you. So hang tight just a minute. All right, let me pull this up. All right, so here we have, and you've seen these charts before, we've got mortgage-backed securities, we've got the S&P, and we've got the 10-year Treasury. So the yield spread between the 2-year Treasury and the 10-year Treasury, the reason that those two have such an important relationship is because that almost every single time over the last 50 years that the 10-year Treasury yield dipped below the 2-year Treasury yield, within the next 18 months that we as an economy have been in a recession. And so we've got the 10-year Treasury here at 2.4. And if I show some additional treasuries, we've got the 2-year Treasury at 2.35. We are almost 6 basis points away. And that may not seem like a lot, but if we go look at the Treasury yield spread historically, and this is going to go back to 1976. So let's pull up this chart. Goes back to 1976. And so this is the historical spread between the 2-year and the 10-year. And so these red areas here, that's every time that the 10-year has dipped below the 2-year. And so you can see here, we had some in the 90s, early 2000s, 2006, 7. And then we had this little bitty blip right here in 2019. And so that's every time that the 2-year or the 10-year has dipped below the 2-year, which is considered an inverted yield spread. And so these gray vertical bars represent recession periods in our history. So if you see here, every single time that we've had an inverted yield spread, we've gone into recession not too long thereafter. And so this is a very, very strong indicator of a recession. It's not 100%, but it's about as close as you can get. And if we look at just the short term here, so back as recently in the beginning of, I guess, April of 2021, we had a spread about 150 basis points. And, you know, it's not too hard to see the direction that this has been going. And so here we are at the end, we are 5 or 6 basis points away from having an inverted yield spread. Actually, earlier today, we had the 10 and the 2 were at the exact same yield. And so we've been seeing this shrink and shrink and shrink. And so that does indicate that we may be in line for a recession sometime in the next 18 to 24 months. What happens in a recession? Home prices do still continue to rise, albeit the pace tends to slow down. But more importantly, for everybody buying homes right now, interest rates come down. And so does that mean you want to wait to buy a home until this interest rates come down? I'm going to say no, because let's say it takes 18 months till we hit a recession and rates start to come down. Well, home prices are going to continue to rise at a pretty rapid pace until we get to that point. And so any gain in interest rate might simply be offset by higher prices on the homes. So the better strategy is to be able to buy with as little money out of pocket as possible. What does that mean? Maybe use lender credits, accept a higher rate to offset some of the closing costs. Seller credits are not really a thing right now in this market, so that's pretty challenging. But leveraging the right strategy to hedge and prepare for a potential recession is going to put you in a position to be able to refinance when rates do come down and be able to save significant money. So having the right strategy in this market is critical more than ever. So working with your lenders, working with my team is going to be a way to help your clients do that. But as real estate agents, now you have some additional knowledge to be able to take to your clients and educate them. You have a better understanding of the market. You have a better understanding of the financial aspect to help prepare them for what's to come. And any questions that they ask you that are really better suited for a lender, get them in touch with your lender, or even better, get them in touch with my team. I'm always available to talk to clients and help them understand what's going on in the market, so that way we can set them up for success. So that's all I have for you today. I wanted to keep it a little bit short. I really appreciate you joining me. If you have any questions, don't hesitate to comment. I can get back to you. And then, of course, my contact information is always right here. But thank you so much. Have an incredible rest of your day. And I appreciate you tuning in to SRT Live with me, Sean Richard. Have a fantastic rest of your Tuesday. Take care.